Have you ever wondered why some of the wealthiest people in the world keep a huge chunk of their money in something that sounds incredibly boring? We're talking about bonds and fixed income investments, and if you think they're just for your grandparents, you're about to discover why that mindset could be costing you serious money. Let's start with the absolute basics. What exactly is a bond? Think of it like this. Imagine your friend needs to borrow $500 from you. Instead of just shaking hands on it, you both decide to write up a simple agreement. Your friend promises to pay you back the $500 in exactly 1 year, plus an extra $25 as a thank you for lending the money. That piece of paper with this promise written on it? That's essentially what a bond is. The beauty of this arrangement is predictability. Unlike stocks where you never know if the price will go up or down tomorrow, bonds tell you up front exactly how much money you'll make and when you'll get it back. This is why we call them fixed income investments, because the income you receive from them is fixed and predetermined. First, we have government bonds. These are issued by federal, state, or local governments when they need money for public projects. U.S. Treasury bonds are considered the safest investments in the world because they're backed by the full faith and credit of the United States government. The trade-off for this safety is that government bonds typically offer lower interest rates than other types of bonds. Now here's where it gets interesting. Bond prices don't just sit still after they're issued. They fluctuate in the market just like stock prices. And understanding why this happens is crucial for any investor. This is why you'll often hear financial experts talk about interest rate risk when discussing bonds. If you need to sell your bond before it matures, and interest rates have risen since you bought it, you might have to sell at a loss. However, if you hold the bond until maturity, you'll still get back the full face value plus all the promised interest payments. Let's address some common misconceptions about bonds that keep many people from considering them. The biggest myth is that bonds are only for older investors or people who are afraid of risk. While it's true that bonds are generally less volatile than stocks, they serve important purposes in portfolios of all types and for investors of all ages. Another misconception is that you can't make real money with bonds. While it's true that bonds generally don't offer the explosive growth potential of stocks, they can still provide meaningful returns, especially when you factor in the power of compounding. Plus, the regular interest payments can provide a steady income stream that many investors find valuable. Speaking of different ways to invest in bonds, let's explore your options. If you want to buy individual bonds, you can work with a broker or use online platforms that specialize in bond trading. This gives you complete control over exactly which bonds you own and when they mature. But it also requires more research, and typically means you'll have less diversification unless you have a substantial amount to invest. For those interested in government bonds specifically, you can buy them directly from the U.S. Treasury through their website, often with no fees. This is particularly attractive for Treasury bills, notes, and bonds, as well as inflation-protected securities known as TIPS. Bonds can serve several purposes in your portfolio beyond just providing steady income. They can act as a hedge against stock market volatility, provide capital preservation for money you'll need in the near future, and offer diversification benefits since bond and stock prices don't always move in the same direction. Before we wrap up, let's address the current interest rate environment and what it means for bond investors. Interest rates have been historically low for many years, which has made bonds less attractive to some investors. However, rates have been rising recently, which actually creates opportunities for new bond investors. Higher rates mean you can lock in better returns, and if rates eventually fall again, the bonds you buy today could increase in value. Bonds and fixed income investments might not be as exciting as the latest hot stock or cryptocurrency, but they play a crucial role in building lasting wealth. They provide stability, income, and diversification benefits that can enhance your overall investment returns while reducing risk.